Hey everyone, welcome to this explainer. I'm absolutely thrilled to have you here. Think of me as your friendly mentor and consider this your personal sandbox where we're going to totally demystify those intimidating financial charts. Now, if you've ever looked at a stock chart and thought, man, that is just a bunch of random jagged lines, well, you are definitely not alone. But today, we're going to learn how those seemingly chaotic lines actually decode the eternal psychological battle between buyers and sellers. All right, let's dive right in and turn you from a spectator into a full-on market detective.
Here's our syllabus for today's lesson. We've got 6 main steps. We'll start with reading the market battleground, look at the anatomy of a breakout, spot big reversals, check out pauses before the jump, set some targets and stops, and finally, talk about trading the messy reality. We're going step by step so you'll know exactly what to expect. Section 1. Reading the market battleground, finding order in the chaos. Let's start with the absolute foundation. What actually creates the charts you're looking at? I want you to picture the market as a literal, high-stakes tug of war. On one side, we've got the bulls. These are your buyers. They're full of optimism, aggressively trying to push prices up. And on the exact opposite side, you have the bears. These are the sellers. They believe prices are going to fall, and they're pulling with all their might to drag that price down. So when you see prices just kind of drifting sideways, it's not that nothing is happening. It's actually this messy, grueling stalemate right in the mud between these two opposing forces.
If you look at raw market data, it just looks like pure chaos. A bunch of red and green bars wildly jumping up and down. But by applying some really simple geometry, we can actually draw boundaries around all that chaos. Chart patterns take that messy tug of war and transform it into predictable footprints of human psychology. It's kind of like a pictorial record of fear and greed. It shows us exactly who is slowly winning the battle right before the final victory is declared.
Section 2. Anatomy of a breakout, the universal mechanics. Now let's explore what actually happens when one side finally wins that tug of war.
A breakout is exactly what it sounds like. It's that definitive, exact moment when the price breaches a barrier that's been holding it captive. To use a super simple analogy, imagine the price is a rubber bouncy ball trapped inside a Rome. The resistance line above is like a glass ceiling, and the support line below is a trapdoor floor. A breakout is that explosive moment when the bouncing ball finally shatters the glass ceiling or crashes right down through the floorboards.
You can actually see how that shattering plays out on a real chart. The price bounces up and down between a flat ceiling and a rising floor. And notice how those bounces get tighter and tighter over time? That is what we call the consolidation zone. The pressure is really building up. Then, right at the breakout point, boom, the price violently shatters the ceiling. And hey, sometimes the price will actually come back down just to briefly touch that broken ceiling. We call that a retest. It's like the market checking to make sure the glass is really broken before rocketing higher.
But as your mentor here, I've got to give you a massive golden rule to write down in your playbook. You simply cannot trust price alone. You absolutely must look at volume, the actual number of shares or contracts being traded. Diminishing volume during pattern formation, followed by a massive volume surge upon breakout, is mandatory. You want to see that massive volume surge the exact moment the breakout happens. Volume is your universal validator. It proves the big players are actually putting their real money behind the move, meaning it isn't just a fake out.
All right, Section 3, spotting the big reversals when the tide turns. Let's look at the major clues that scream the market is about to completely change direction.
These are the absolute heavyweights of the charting world. First, you've got the double top, which looks exactly like a giant letter M. The price rallied up, hit the ceiling, fell back, tried one more time, and just failed again. The bulls are totally exhausted, and a massive downward reversal is coming. Then you have its twin, the double bottom, which is shaped like a W. In this case, the bears tried twice to break the floor and failed, meaning the bulls are about to take over. The absolute crucial takeaway here is this. When the market tests a major barrier twice and fails, a powerful reversal is usually right around the corner.
These concepts build into one of the absolute most famous patterns out there, the cup and handle. This thing is a massive engine for growth. You'll see a long, slow, U-shaped dip. That's the cup. It represents a really healthy changing of the guard from weak sellers to strong buyers. Then, right after that, you get the handle, which is just a slight downward drift. Think of the handle like a springboard being pushed down. The deeper it compresses on lighter volume, the more violently it's going to launch the price upward when it finally breaks out.
So what happens when the market just gets tired? I mean, reversals are great, but markets don't reverse every single day. Often, a really strong trend is well underway, but the buyers or sellers simply need a breather. Think of a marathon runner. They can't just sprint 26 miles without occasionally slowing down to grab a quick cup of water, right?
Which brings us to Section 4, pauses before the jump. The strategic pause. Here are the patterns showing us the current trend is merely resting before violently resuming.
The most common quick breathers are flags and pennants. Imagine a massive vertical price movement. That's our flagpole. It's a huge, sharp jump. But instead of falling all the way back down, the price just drifts slightly lower in a tiny, tight little channel. That little flag just represents temporary profit-taking by the early buyers. Once that brief pause is over, our marathon runner finishes the race, and get this, they usually travel the exact same distance as that initial flagpole.
Next up, we have the pressure cookers, triangle formations. These essentially compress the market over weeks or even months. Take an ascending triangle, for example. You have a flat, unmoving glass ceiling on top, but the floor underneath is rising higher and higher. What does that mean? It means buyers are getting so aggressive that they're willing to pay higher and higher prices on every single dip. They are literally squeezing the bears against the ceiling, preparing to aggressively shatter it.
Now, wedges are where you really need to put your detective hat on, because they are deeply counterintuitive. In a rising wedge, yes, the price is generally moving up, but notice how the boundary lines are actually squeezing together. The buyers are seriously struggling. They are using maximum energy just to push the price a tiny bit higher each time. It's a classic sign of total exhaustion, which is exactly why a rising wedge actually results in a violent downward snap.
Section 5. Setting targets and stops. Rules of engagement. Spotting the footprints is really only half the battle. Now I need to teach you how to protect yourself and set your goals before you ever risk a dime.
Here is the exact simple mathematical formula the professionals use. To know your target, meaning where you actually want to take your profits, you just measure the maximum vertical height of the pattern itself, and you add that height to your breakout point. It's that easy. But honestly, more importantly, you need a stop loss. That is your ultimate safety net. If a breakout turns out to be a lie and the price falls back down, that stop loss automatically pulls you out of the market so you live to trade another day. Absolutely crucial.
You might actually want to pause and grab a screenshot of this trader's field guide. Consider it your ultimate cheat sheet summarizing everything we've just covered. It lays out the short-term flags, the medium-term triangles, and the long-term head and shoulders patterns. And it tells you exactly what bias each pattern implies. Definitely keep this handy when you're doing your own chart analysis later.
Section 6. Trading the messy reality beyond the pattern. All right, it is time for a gentle, yet very necessary, reality check. The live market definitely has a mind of its own. This is where expectation meets reality. We study these beautifully clean, textbook perfect patterns, right? But real-world market chaos is a completely different beast. The lines get messy. There are random spikes, we call them wicks, that temporarily pierce your boundaries, and the shapes are almost always asymmetrical. The market is driven by millions of human emotions, and let's face it, human emotions are messy. So adaptability and an understanding that the textbook is really just a guide is absolutely required. So to actually survive all that chaos, you must adhere to the holy trinity of execution. Step 1, wait for confirmation. Never, ever jump the gun. Wait for a definitive close above your barrier. Step 2, look for volume validation. Like we said earlier, if there's no massive surge in volume, it's highly likely a trap. And step 3, unwavering risk management. Patterns give you probability, guys, never certainty. You literally must use those stop losses.
I want to leave you with this final profound piece of mentor wisdom. Trade the reaction, not the prediction. Don't gamble on what you think the pattern is going to do. Let the market make the very first move. Let it shatter the ceiling or break the floor, and then react to what it has actually shown you. You now possess the absolute blueprints to decode this psychological battleground. So the real question is, what will the market's next reaction be?